studying your last two. I swim med when they turned in. The styren down to mute. And can learn the pole that sunk he died.
As we've seen throughout this course, effective tax planning involves making many important decisions. But before any of those decisions are made, there is one fundamental principle that every professional tax advisor follows. Build your tax plan using today's facts, not tomorrow's predictions. Let's begin with the left side of the slide. Notice the tax advisor sitting with a client and reviewing several important documents. These include the current year's financial statements, the current tax return, payroll records, the corporation's actual profit, and current investment information. Each document has been verified and represents information that is known with confidence. The advisor isn't guessing. They are working with facts. That's why the client says, "Let's plan using what we know." This simple idea is one of the foundations of professional tax planning. Now look at the right side of the slide. The comparison between known facts and future predictions highlights why this approach is so important. On the left are things we know today. We know the client's actual income. We know their actual business expenses. We know the current tax rules. We know the corporation's current profitability. And we understand the client's current personal goals. These are reliable facts that can be used to make informed tax planning decisions. Now compare that with the list on the right. Will business income increase next year? Will tax laws change? What investment returns will the client earn? Will the business grow faster than expected? Will the client's personal circumstances remain the same? The honest answer is that nobody knows for certain. These are predictions, not facts. Notice the balance scale at the bottom. The side representing known facts is heavier than the side representing the unknown future. This illustrates an important professional mindset. Good tax planning places more weight on reliable information than on uncertain forecasts. Of course, advisors should discuss future goals with their clients. If someone plans to retire in 5 years, purchase a home next year, or expand their business, those objectives certainly matter. But the actual tax calculations should still begin with verified financial information that exists today. Future plans provide direction. Current facts provide the foundation. This approach also helps reduce unnecessary risk. If a tax strategy is based entirely on assumptions that later prove incorrect, the client may end up with an outcome that no longer fits their circumstances. By using current year numbers, advisors create recommendations that are accurate, defensible, and based on evidence rather than speculation. Then, as new information becomes available in future years, the strategy can be updated. That is exactly how professional tax planning is intended to work. The message highlighted across the bottom of the slide summarizes this principle perfectly. Professional tax planning begins with reliable information, not uncertain forecasts. This doesn't mean advisors ignore the future. Instead, they recognize that the future is constantly changing. The most effective approach is to make the best possible decision using today's verified facts, while remaining flexible enough to adjust the plan as new information becomes available. In the next slide, we'll see why relying too heavily on future projections can sometimes lead to poor tax decisions, and why experienced advisors prefer a disciplined process of reviewing and updating tax plans each year. In the previous slide, we learned that professional tax planning begins with today's verified financial information. Now let's explore why relying too heavily on future projections can sometimes lead to poor tax decisions. At the top of the slide, you'll see a timeline that begins with today. Today, a tax advisor has access to reliable information. They know the client's current income, business performance, tax position, and financial goals. However, as we move into the future, certainty begins to disappear. Perhaps the business earns more profit than expected, or maybe profits decline because of changing market conditions. Tax laws could be amended. A client who planned to retire in 2 years may decide to continue working for another 5. Someone planning to purchase a home next year may postpone those plans because interest rates increase or personal priorities change. Every one of these future events is uncertain. Some may happen, others may never occur. That uncertainty is exactly why experienced advisors avoid building tax strategies around assumptions that cannot be verified. Now compare the two planning approaches shown in the middle of the slide. On the left, planning begins with predictions. The advisor guesses what future income might be. Those guesses lead to assumptions. If those assumptions turn out to be incorrect, the tax strategy may no longer fit the client's actual situation. The result can be poor tax decisions that later require correction. For example, the client may pay more tax than necessary, miss valuable deductions, create unintended RRSP or CPP consequences, or implement a compensation strategy that no longer makes sense once circumstances change. Now look at the approach on the right. Professional advisors begin with actual numbers. They use current financial information to make the best possible decision today. Then, instead of trying to predict every future event, they simply review the plan again next year. If circumstances have changed, the strategy is adjusted. This process creates flexibility. Rather than locking the client into a plan based on uncertain forecasts, the advisor continually updates recommendations as new information becomes available. This approach produces better long-term results because every year's decisions are based on the most accurate information available at that time. One of the most important illustrations on this slide appears near the bottom. Notice the advisor holding a compass instead of a crystal ball. The crystal ball represents predicting the future. Professional advisors do not claim to know exactly what will happen next year. Markets change. Governments introduce new tax legislation. Businesses grow or contract. Families experience major life events. No one can predict all of these changes with certainty. The compass represents a much better approach. A compass doesn't predict the future. Instead, it helps you make good decisions based on your current location and your intended direction. Professional tax planning works exactly the same way. Advisors use today's facts to determine the best direction for the client. As new information becomes available, they simply adjust the course. The message highlighted at the bottom of the slide summarizes this philosophy perfectly. Good advisors use facts and adjust each year instead of trying to predict an uncertain future. This doesn't mean future goals are ignored. Far from it. Future objectives remain extremely important, but the tax calculations themselves are built on evidence rather than speculation. That combination, clear long-term goals supported by accurate current year information, is what makes professional tax planning both practical and reliable. In the final slide of this section, we'll see how annual reviews allow tax advisors to continually refine a client's strategy, ensuring that tax planning remains accurate, relevant, and effective as both life and tax laws evolve over time. We've now reached the final lesson of this section, and it highlights one of the most important habits of professional tax advisors. The best tax plans are never static. They evolve as the client's life, business, and the tax system continue to change. Let's begin with the circular process shown on the left side of the slide. Everything starts with the current year's financial information. Using today's verified numbers, the advisor develops and implements the most appropriate tax strategy. But the story doesn't end there. As the year progresses, businesses grow, profits change, investments perform differently, families experience major life events, and governments may introduce new tax legislation. Because of these changes, the advisor schedules an annual review. During that review, they evaluate everything that has changed since the previous year. Based on the updated information, the tax plan is adjusted where necessary. The revised strategy is then implemented for the next tax year, and the entire process begins again. Notice that the process forms a continuous cycle rather than a straight line. Professional tax planning is an ongoing relationship, not a one-time calculation. Now look at the advisor's checklist in the center of the slide. Each year, the advisor reviews several important areas. They begin with the latest financial statements to understand the corporation's current performance. They review the current tax rules to identify any legislative changes that could affect planning opportunities. They ask whether there have been any family changes, such as marriage, children, retirement, or changes in financial responsibilities. They evaluate business performance and compare actual results with previous expectations. Investment performance is reviewed because changing investment income may influence compensation decisions. The advisor also discusses any new client goals. Perhaps the client now wants to purchase a home, expand the business, begin retirement planning, or transfer the business to the next generation. Finally, the advisor determines whether the existing compensation strategy should be adjusted. Every one of these questions helps ensure that the tax plan continues to reflect the client's current situation rather than last year's assumptions. The panel on the right reinforces this idea. Notice how the client's circumstances evolve from year 1 to year 2, and then again to year 3. The business changes. The family changes. Financial priorities change. Because life changes, the tax strategy must also change. A compensation plan that was ideal 3 years ago may no longer be appropriate today. This is exactly why annual reviews are so valuable. Now follow the journey shown across the bottom of the slide. Everything begins with current facts. Those facts lead to smart planning. Each year, the plan is updated using new information. Those updates produce better decisions. Better decisions create greater long-term tax efficiency. And over time, consistent tax efficiency contributes to long-term financial success. The comparison on the lower right highlights the difference between two very different approaches. A one-time tax plan gradually becomes outdated. As years pass, opportunities may be missed because the strategy no longer reflects the client's current circumstances. In contrast, an annual review keeps the strategy current. The plan is refreshed each year, allowing the advisor to respond to changing tax laws, business conditions, and personal goals. The result is a strategy that remains effective year after year. The message highlighted across the bottom of the slide summarizes the entire lesson. The best tax plan is not the one that predicts the future. It is the one that uses today's facts and adapts as life changes. This principle captures the essence of professional tax planning. Good advisors don't attempt to predict every future event. Instead, they make the best possible decision using accurate information available today. Then they review, refine, and improve the plan every year as new information becomes available. That disciplined process allows clients to remain tax efficient while staying flexible enough to respond to whatever the future brings. As you complete this course, remember that successful tax planning is not about finding one perfect strategy that lasts forever. It is about continually combining sound knowledge, accurate information, thoughtful planning, and regular reviews to help clients achieve long-term financial success while remaining fully compliant with tax law.